Good morning friends, welcome to the point. In this video we will understand the difference between equity and debt. So let's start with the definition quickly. Equity market or a stock market is a financial market in which shares are issued and traded through exchanges. So what happens in equity? Whenever the equity is issued by any company, so you get a ownership of it. Let's suppose if you are holding shares of Reliance Industries or let's say Tata Power. Now what does holding a share in Reliance Industries or Tata Limited means? It means you are a shareholder, means a part owner. Let's suppose you have 5,000 shares in Reliance Industries Limited, and now that 5,000 shares just mean 0.001% of stake in it. So you are the owner of Reliance Industries Limited by 0.001%. So it's a very small chunk of it, but yes, equity shows the ownership in the company. Stocks are essentially securities that are claim on the earning and assets of a corporation. So what is this share? Share is equal to stock. Now what does stock shows? It shows claim on the earnings and assets of the corporation. So whatever this Reliance Industries is gonna earn in the financial year, you will get it in the form of dividend. So stocks are essentially a claim on earnings and asset of a corporation. Now what is this debt market? So whenever a company wants to doesn't want to dilute its ownership and wants to take loan from the market, so it approaches this debt market or the credit market. So debt market or credit market is financial market in which investors are provided with issues and bonds and trading of debt securities. Debt instruments are assets that require a fixed payment to the holder, usually with an interest. So what happens is, let's suppose Reliance Industries want to have a loan of 500 crore and does not want to issue shares in lieu of it. It wants to create, or it wants to take it as a loan. So it will approach the debt market and issue debentures or maybe bonds. Fine, of rupees 500 crore, will get 500 crore in return and give the debenture certificate or the bonds to the holders or the person who have provided money. In return, every year now this Reliance Industries has to provide interest on the investment that these debenture holders have made. So in case of what was happening in case of this shares, the shareholders were getting dividends as a return on their investment. In case of this debt market or the debt securities, the investors will get interest on their investment. So this debt market does not, or so the debt securities does not show the ownership in the company, whereas shareholders or the share owners are a part of or are the owners of the company by whatsoever percentage their capital contribution is. We will quickly take up this table showing the difference between stock and bonds. So meaning an equity instrument representing ownership interest in a corporation. So it shows the ownership, as I told you, by whatsoever percentage. Now what is this bond? A debt instrument. Debt, it creates a debt or a loan on the company with a promise to pay back the principal amount with interest. The company will pay the principal amount, also keep on servicing the interest till the principal amount is paid back. Who are the issuer? It's in this case it's usually the corporates which go for the share issue. And case of bonds, it is companies as well as the government also. If a government of the country wants to raise money, it does through bonds. Status of holders. Shareholders are the owner of the company, as I explained, by whatsoever percentage their capital contribution is. Bondholders are the lenders to the company, aka creditors of the company. Form of return, they get the return in the form of dividends, they get in the form of interest payment or at the rate whatever is mentioned on the debenture deed or the conditions as per the bonds on whatever rate of interest it was issued. Risk level high, since it depends upon the performance of the issuer, so no guarantee returns. So shareholders are the last one to be paid when the company goes into liquidation, since you are the owner. Let's suppose you are holding, just think it from your own point of view. So let's suppose you are the owner of some company, and the company, God forbid, goes into liquidation. So first of all the creditors and the persons who have lended you money, they will be paid. Then the employees will be paid, salary staffs are there, and there's so much of your suppliers are there, and in the end you are the one, whatever the residue amount that will be left will be given to you, since you are the owner of the company. So in the case of shares, as I told, you are the owner of the company by whatever percentage it is. You are the last one to be paid if the company goes into liquidation. So the risk is certainly high if compared to bonds. Whereas in the case of bonds, now you are the creditors of the company. No matter what happens to the company, you will be paid or repaid the principal amount and the interest with this. So what are the major risks associated? It is the market risk, market fluctuation. Let's suppose if the market goes for a toss, if it goes bearish, which means if the market is the Sensex or whatever the index which is prevailing in the country goes down, then the value of the shares will also goes for a toss. In case of bonds, it is the interest rate risk. If the interest rate fluctuates, so is the case, so is the interest rate that you will be getting will also fluctuate. The last point of difference is the additional benefits. Shareholders get the right to vote in case if the company is taking any decisions. So the shareholders meeting is called upon, and the shareholders get a right to vote and participate in the management of the company. Whereas bondholders are just the creditors of the company, and they don't get any such benefit with regards to voting, but the benefit that they get is that they get preference in terms of repayment and also on liquidation of the company. So these are the major differences between stocks and bonds, and the difference between the debt market and the equity market. Just keep revising whatever I am teaching you over here. So this is all for today's video. Stay fit, stay at home. Thank you so much.